It appears all but certain that the Federal Reserve tomorrow will cut interest rates. That move would mark the third straight meeting with a rate cut. Joining me now, CBS News business analyst Jill Schlesinger. Jill, it's great to see you. Thanks for joining us. The market has priced this in. The market has priced this in. What effect, if any, will it have on the real economy?
Listen, this is going to be helpful if you're a borrower. If you're carrying a big credit card balance, you'll start to see those interest rates slide down just a little bit. But again, the overall level of a credit card interest rate is more than 20%. Car loans are running at more than 7.5%. Personal loans are expensive. And although the Fed does not actually control the interest rate associated with a mortgage, the general trend lower has brought mortgage rates down from those near 8% levels. So, I think it's helpful if you are a borrower, that's fine. If you're a saver, of course, you're kind of gnashing your teeth on, gee, I missed those 5% CDs. You're not going to see those anymore. But, at the end of the day, these quarter percentage point moves are incremental, and we'll see where we land. I think the more interesting thing about tomorrow is going to be hearing from Chairman Powell as to what he sees as the path forward beyond this particular meeting. Remember, the Fed was meeting without a lot of economic data. They are going to make their best bet on what's happening, but they may wait for more of that catch-up material to fall into their lap before deciding to cut again, or maybe to leave rates where they are.
And Jill, that's a really important point because the Fed always says, and Chairman Powell underscores this every press conference after a meeting, the Fed is data dependent. Well, if you're a data dependent institution and you are lacking a lot of your core and most relied upon data, you are made blind a bit.
Yeah, I think it's very interesting. In Nancy's piece and talking to a lot of people, we focus so much on groceries. And I think the Fed is also quite concerned about the service side of the economy. Remember, goods account for 30% of our spending, 70% is services. So I want you to think about this. If you are a middle class American household, maybe you're making $60, $70, $80, $90,000 a year, an enormous part of your pay is going towards childcare or health care or elder care or education. And these service numbers, the inflation rate for services has been very sticky. This has nothing to do with tariffs, by the way. It may have something to do with some immigration policies, but the Fed is concerned that inflation could surge a bit from these levels. You said 3%, maybe we get to 3.5%. Remember, those big Trump tax cuts mean that there are going to be this influx of cash when we get to tax season. Those dollars that come back to individuals as refunds will be spent, and that too could cause inflation. So the Fed is weighing all these measures and also looking at a labor market that is not collapsing, but cooling. So they're trying to thread the needle. Again, their two jobs: make sure the economy is strong enough to create a job for anyone who wants one, but also control the price appreciation or inflation.
Many layers of inflation, not just goods, but services. Jill, thank you so much for that great analysis. I really appreciate it.